Hello everyone, I'm Pacchia and this is Bloomberg Law on Demand. We've seen a flurry of activity in the M&A space so far in 2011, and here to help us make sense of that trend, I'm happy to say we have Frank Aquila, partner at the law firm Sullivan Cromwell based here in New York City, and he's also a columnist for Business Week. As we look at what's happened so far in the year, it seems as if the predictions from 2010 have come true to some effect. We've had plenty of deals working through the system. What do you make of the trend and how sustainable is it?
To a certain extent, Lee, it really is, as you say, what we expected. If you go back a year or so to early 2010, I think a lot of people thought it was going to be really a boom year in M&A. It was a very good year in M&A. The second half was certainly much stronger than the first half was, but it was not at the levels that we had expected. 2011, on the other hand, really has started off very, very well. We're seeing lots of transactions, different parts of the globe, different industries and sectors, some of them private equity deals, most of them strategic deals. We haven't seen the sort of huge mega 25, 50,
right.
100
We've seen
billion
a bunch of few billion-dollar deals, but nothing
right.
huge quite as of yet.
To a certain extent, the mark of an M&A boom market to me is that constant stream of $2, $10, $15 billion transactions. You can have one $50 billion transaction which will make a month or a quarter look fabulous, right. But those can occur even in weak M&A years.
That could be a one-off. Wanted to get your thoughts on the historical context of this boomlet, if we can call it that. Is this a matter of an uptick coming after a broader economic collapse, or is this a strong uptick no matter how you look at it?
I think it's a strong uptick no matter how you look at it, but I think you're making a very good point, and that is that we had a period, 2008 through really the first half of 2010, when M&A activity was not only way down from the immediately previous period, but to a certain extent it was probably down historically from what you would have expected of a global economy of today's size. We all know the reasons for that, the credit crisis and everything else that went on, but there clearly was a pent-up demand. There is a pent-up demand because lots of transactions that companies would have engaged in 2008 and 2009 that didn't occur, now they're looking at those transactions again, or those types of transactions. May not be the same target, may not be exactly the same approach they would have taken a few years ago, but essentially they're looking to fill the holes, fill the gaps that they found that they had in their portfolio during the credit crunch, which really was a stress test of whether or not a company had the right sort of balance within their strategic portfolio's.
As we go through this cycle, where do you see valuations trending? Are they going to trend higher, lower? What's going to be the catalyst for change as we go through the year?
Certainly, deals are becoming pricier, but not overly expensive. I think companies have plenty of cash, and they have access to more cash at historically low interest rates, not the same sort of terms that they had a few years ago when you were seeing particularly private equity buyers make purchases at 8, 9, 10 times leverage, but we're seeing healthy leverage levels. We're seeing interest rates which are historically low, and so there's a lot of access to capital. That then raises the question about valuation. And valuation really is a function of what is the value of the intrinsic value of the asset being purchased, and what is the perception of economic growth. As businesses believe the economy, both in the U.S. and globally, is strengthening, the value of those assets is going to go up. So the value in the hands of the acquirer is going to go up. They're willing to pay more. And I think that's what we're going to see. When you run into trouble is when asset values, in effect, or asset prices, in effect, outrun what the value is to the acquirers. And I don't think there's a sense today that that's what's happening. So I think we're going to see deal prices go up, we're going to see values go up, but ultimately the value in the hands of the acquirer, the value created in the hands of the new combined entity is still going to be quite significant in most cases.
We've seen a lot of all-cash deals so far in the year. Do you expect firms to rely on cash going forward, or do you think they might convert to other methods?
We may see a greater number of stock-for-stock deals. My sense is that at least for the foreseeable future, the bulk of merger consideration is going to be cash, partially because most companies have a lot of cash. Even the private equity groups have significant amounts of equity that has been pledged to them. So cash is certainly readily available. Plus, as I mentioned, it's available to the best borrowers at historically low rates. And so I think companies will opt to keep their shares, buy back more shares, and use cash to make acquisitions. Will that change in the future? Of course it will. We always see these things in cycles. But at the moment, I would be focused mostly on cash transactions.
Okay, sounds like a pretty good time to be in the M&A space, but let's skew pessimist for just a moment. What are the potential catalysts out there to stop this trend or maybe trigger a decline in the volume of deals?
Right. A minute ago, we were talking about the fact that everyone expected, particularly early 2010, to be a very strong year for M&A. Then we had really the crisis in Europe, the debt crisis, the sovereign debt crisis, a lot of attention on healthcare reform and politics. So I think what I'm always concerned about is some extraneous event, some political, economic event somewhere in the world that is going to change business leaders' perception of what the future, the near-term future is. Could it be unrest in the Middle East? That has often been a catalyst for uncertainty. Could it be further sovereign debt crises? Could it be crises here in the U.S. if certain states start defaulting on their municipal and state obligations? That's always a possibility. So that's what I worry about. The fact of the matter is that history would prove that the things you sort of list out and say, I'm worried about this, this, and this, rarely happen, and usually it's something which we don't expect. But again, it would be an external event that either dramatically cuts economic growth or at least shakes the business community's confidence in future economic growth.
One thing I certainly didn't expect to happen this year was to see the Jets do so well in the NFL. I'm going to ask you to speculate. Jets or Steelers next week?
Oh, Jets, absolutely all the way. I am never surprised by a Jets victory. I'm only surprised by a Jets loss because I expect to win every time.
Can you give us a score?
28-17 Jets, and this is the national debut of Rex and Mark, and I think we're going to be seeing a lot more of them for years to come.
All right, yes. Frank, always a pleasure. Thanks so much for coming in today. Frank Aquila from the law firm Sullivan Cromwell, based here in New York. If you'd like to learn more about the issues we just discussed, go check out our offerings on BloombergLaw.com and on the Bloomberg Terminal. I'm Pacchia. Thanks for watching.